Gold has captivated humans for millennia, not just for its beauty, but as a symbol of wealth and a store of value. But in today's fast-paced digital world, you might wonder, is gold still relevant? Well, let me share some glittering facts with you. Did you know that despite market fluctuations, gold has maintained its purchasing power over the last century? That's right, while currencies can rise and fall, gold has stood the test of time. But here's the problem. Many of you have asked, how do I start investing in gold without feeling like I'm lost in a maze of options? It's a golden question, and I've got the answers. In this video, I'll break down the top ways to invest in gold for beginners, from the shiny allure of physical gold to the modern convenience of gold ETFs. I'll tackle the most asked questions from our community, like what's the difference between gold coins and gold bars, and how do gold mining stocks work? So, whether you're looking to safeguard your wealth against inflation, diversify your investment portfolio, or you're just gold curious, I've got the treasure map you need. So let's get started. Gold IRAs. Diving into the world of gold IRAs can be like embarking on a treasure hunt where the treasure is not just gold, but also the potential to make your retirement years as golden as possible. Imagine a treasure chest where instead of just storing jewels and coins, you're storing your future. Bits of gold that promise to shine even when the economic seas get stormy. A gold IRA is that chest, a special type of retirement account that lets you save gold, yes, actual gold, as part of your nest egg. It's like having a financial lifeboat, making sure you're ready for whatever comes your way. How to start? First up, you need a map to your treasure. That's your custodian. This is a company approved by the IRS to keep your gold safe and sound. They're your guide, helping you navigate through the paperwork and rules. Once you've chosen a custodian, you'll need to open a new IRA account or roll over funds from an existing retirement account, such as a traditional IRA or 401k, and now select the gold. Not all gold is created equal in the eyes of the IRS. You'll need to pick out gold coins or bars that meet purity standards. Think of it as choosing the shiniest jewels for your chest. Typically, gold coins and bars must be at least 99.5% pure. Some approved coins include American Eagle coins, Canadian Maple Leaf coins, and certain other bullion coins and bars that meet the purity requirements. Arrange for storage. The IRS prohibits you from personally holding the physical gold in your IRA. Instead, it must be stored in an IRS-approved depository. Your custodian will help you arrange for storage and ensure that your gold is securely held in a facility that complies with IRS regulations. Investment strategy. Diversification. A common strategy for gold IRAs is to use them as a diversification tool within a broader retirement portfolio. You might allocate a portion of your retirement funds to gold to hedge against inflation, currency devaluation, and economic uncertainties. Long-term holding. Gold IRAs are typically suited for long-term investment horizons. The idea is to hold onto the gold and potentially benefit from its price appreciation over time. Dollar cost averaging. Some investors choose to apply the dollar cost averaging strategy to their gold IRA contributions, purchasing gold at regular intervals to mitigate the impact of price volatility. Remember, there are fees for setting up and maintaining a gold IRA, and for storing your gold. Also, selling gold isn't as quick as selling stocks. It takes a bit more time and effort, and gold prices can jump around, especially in the short term. Gold bullions. Investing in gold bullions can be an attractive option for beginners looking to diversify their investment portfolio with a tangible asset that has historically held its value. Gold bullions come in two main forms: bars and coins. Gold bars are the most common form of gold bullion and are produced by various private mints and refineries. They range in size from small 1-gram wafers to large 400-ounce bars held by central banks. For beginners, smaller bars like 1-ounce or 10-ounce bars may be more accessible due to their lower price point. Gold coins are minted by government mints and often have a face value in their country of origin. Popular gold coins include the American Gold Eagle, Canadian Gold Maple Leaf, and South African Krugerrand. Coins can carry a higher premium over the spot price of gold due to their collectability, design, and sometimes legal tender status. Buying process. Research dealers. Look for reputable dealers with positive reviews and transparent pricing. Check for accreditation from industry organizations like the Professional Numismatists Guild, PING, or the American Numismatic Association, ANA. Understand pricing. The price of gold bullion is based on the spot price of gold, which fluctuates throughout the trading day. Dealers will add a premium to this price to cover their costs and profit. Place your order. Once you've chosen a dealer, you can place your order online, over the phone, or in person. Payment methods typically include bank wire transfers, credit cards, or personal checks, confirmation and delivery. After your payment is processed, you'll receive a confirmation of your purchase and details on delivery. Ensure that the dealer uses insured and trackable shipping methods. Storage options. Home storage. Some investors choose to store their gold at home in a safe or other secure location. While this offers immediate access, it also poses risks such as theft or loss. Bank safe deposit box. Renting a safe deposit box at a bank provides a secure off-site location for your gold. However, contents in safe deposit boxes are typically not insured by the bank. Third-party storage facilities. Specialized precious metal storage facilities are for high-security vaulting services. These facilities are often insured and provide a balance of security and accessibility. Selling process. Check the current spot price of gold and decide if it's the right time to sell based on your investment goals. You can sell to local coin shops, online dealers, or through peer-to-peer platforms. Compare offers to ensure you get the best price. For transaction, follow the buyer's process for selling your gold. This may involve shipping your gold to the buyer for authentication or conducting the sale in person. Once the gold is verified, you'll receive payment. Methods can include check, bank wire, or cash if selling in person. Risks. Market volatility. The price of gold can be volatile in the short term, influenced by economic events, currency values, and market sentiment. Storage and insurance costs. Safe storage of physical gold can incur costs, and insurance can add to the expense. Liquidity. While gold is generally considered a liquid asset, quickly converting large amounts of bullion to cash may not always be straightforward. Gold ETFs and mutual funds. Investing in gold through exchange-traded funds, ETFs, and mutual funds is a popular option for beginners who prefer not to deal with the physical aspects of gold bullion. These financial instruments allow investors to gain exposure to the price movements of gold without the need to store or insure physical gold. Gold ETFs are traded on stock exchanges, much like shares of a company. Each share of a gold ETF represents a portion of gold, often 1/10 of an ounce. These ETFs track the price of gold and reflect its current market value. Popular gold ETFs include SPDR Gold Shares, GLD, and A Shares Gold Trust, IAU. Gold mutual funds invest in a variety of gold-related assets, including gold mining companies, gold futures contracts, and physical gold. These funds are managed by professional fund managers who aim to achieve growth by selecting a diversified portfolio of gold-related investments. Examples include the VanEck International Investors Gold Fund, INVX, and the Fidelity Select Gold Portfolio, SACH. How to invest. Open a brokerage account. To invest in gold ETFs, you'll need a brokerage account. Many online brokers offer easy account setup and low fees. For mutual funds, you can also invest directly through the fund company's website in addition to using a brokerage account. Research and select your investments. Look into various gold ETFs and mutual funds to understand their performance history, management fees, and investment strategy. Consider factors like expense ratios, liquidity for ETFs, and the fund's track record. Consider your investment goals. Align your choice with your investment goals, risk tolerance, and investment horizon. ETFs offer liquidity and are easy to trade, making them suitable for short-term investment strategies. Mutual funds, on the other hand, may be more suitable for long-term investors looking for managed exposure to gold-related assets. Place your order. Once you've selected a gold ETF or mutual fund, log into your brokerage account and place your order. For ETFs, you can buy shares just like stocks, either at the market price or using limit orders to specify a price. For mutual funds, you'll invest a specific dollar amount, and the purchase will occur at the fund's next calculated net asset value, NAV. Monitor your investment. Keep an eye on the performance of your gold ETF or mutual fund in relation to your investment goals. Be aware of any changes in the market conditions that might affect the price of gold and, consequently, your investment. Considerations. Costs and fees. Be mindful of management fees, expense ratios, and any other costs associated with gold ETFs and mutual funds. These can impact your overall returns. Market risk. Like any investment, gold ETFs and mutual funds are subject to market fluctuations. The value of your investment can go down as well as up. Indirect ownership. Investing in gold ETFs and mutual funds means you don't own physical gold directly. Your investment is in shares of a fund or trust that, in turn, owns gold or gold-related assets. Gold futures and options. Imagine you're at a coffee shop with a friend who's super into the gold market. They start telling you about gold futures, which are basically promises to buy or sell a certain amount of gold at a future date. It's like saying, "Hey, I'll buy 100 cookies from you at $1 each next month." But instead of cookies, it's gold, and instead of $1, it's usually a lot more money, like 100 troy ounces at $1,000 per ounce, which adds up to a cool $100,000. Now, because I am talking about a lot of gold and money here, futures are usually the playground for the more experienced folks. They like it because the cost to play, commissions, are pretty low, and you don't have to put all the money down at once. That's what margin is for. But here's the kicker. Depending on the contract, you might end up with a bunch of actual gold on your doorstep if you're not careful. Some contracts are settled with cold hard cash, and others with the shiny metal itself. So, you've got to read the fine print unless you want to surprise your mail carrier. The cool thing is, if the price of gold goes up, you're sitting pretty because you got in at the lower price. But if it goes down, the most you'll lose is the deposit, the premium, you paid for the option. Now, while options give you some wiggle room and limit your losses to what you paid for them, they do come with a cost above the actual value of the gold. And let's be real, the whole futures and options scene can be a wild roller coaster ride. It's not everyone's cup of tea because the prices can swing a lot and fast. How to invest. Step 1. Choose the right brokerage. First things first, you'll need a brokerage account, but not just any account. You need one that's specifically set up for futures trading. Think of it as needing a special key to enter the gold futures treasure chest. While not every brokerage firm offers this key, some big names do, including Trade and TD Ameritrade. These platforms are like your trusty sidekicks, ready to help you embark on your gold futures journey. Step 2. Understand the requirements. Now, before you can start trading, there's a bit of a quest you need to complete. Since gold futures trading is a bit more complex and comes with its own set of risks, not everyone is handed the map straight away. If you're not already a professional trader, you might need to apply for futures trading privileges. This could involve filling out some forms and possibly meeting additional criteria to show you're ready for this adventure. Think of it as proving you're ready to sail the high seas of gold futures trading. Step 3. Get to know CME Group. Another path to trading gold futures is through CME Group. They're like the guardians of the commodity futures exchange kingdom, including NYMEX, where a lot of the gold futures action happens. Getting familiar with CME Group can provide you with valuable insights and tools for your trading journey. Step 4. Educate yourself. Before you set sail, it's crucial to arm yourself with knowledge. Gold futures trading can be thrilling, but it's also filled with waves and storms. Spend some time learning the ropes, understand what futures contracts are, how they work, and the strategies traders use. There are plenty of resources out there, from online courses to trading forums, where you can learn from seasoned adventurers. Step 5. Start small and be patient. For a beginner, the world of gold futures can be overwhelming. It's wise to start small. Think of it as dipping your toes in the water before diving in. This approach allows you to get a feel for the market's ebb and flow without risking too much treasure. And remember, every seasoned trader was once a beginner. Patience and persistence are your best allies. Gold mining company stocks. Investing in gold mining company stocks is a way to gain exposure to the gold industry without buying physical gold. For beginners, it's important to understand that when you invest in a gold mining company, you're buying shares in the company's future profits or losses, as much as you're investing in gold itself. How to invest. Step 1. Research and education. Before you invest a penny, it's crucial to educate yourself about the gold mining sector. Learn about the different stages of mining, from exploration and development to production and reclamation. Understand the risks and challenges the industry faces, such as fluctuating gold prices, operational risks, and geopolitical factors that can affect mining operations. Step 2. Set your investment goals. Determine what you want to achieve with your investment. Are you looking for long-term growth, dividend income, or a hedge against economic uncertainty, your goals will influence which companies you should consider for investment. Step 3. Open a brokerage account. If you don't already have one, you'll need to open a brokerage account. There are many online brokerages that offer easy-to-use platforms for beginners. Look for one with low fees, good customer service, and educational resources for new investors. Step 4. Analyze gold mining stocks. When you're ready to start looking at individual companies, consider the following factors. Size of the company. Larger companies, known as senior gold miners, generally have more established production and reserves. They may offer more stability but potentially less growth. Smaller junior gold miners may have higher growth potential but come with higher risk. Location of operations. The location of a company's mines can significantly impact its risk profile. Mines in politically stable countries with a history of mining are generally less risky than those in less stable regions. Cost of production. Look at the company's cost of production, often referred to as all-in sustaining costs, AISC. A lower AISC means the company can remain profitable even when gold prices fall. Financial health. Examine the company's balance sheet. Look for companies with low debt, strong cash flow, and a solid plan for growth. Management team. A company with a strong, experienced management team is more likely to succeed. Research the track records of the CEO and other key executives. Step 5. Diversify your portfolio. Don't put all your eggs in one basket. Consider investing in a mix of gold mining stocks, including both senior and junior miners. You might also look into gold mining ETFs, which can provide diversified exposure to the sector. Step 6. Monitor your investments. Once you've invested, keep an eye on your stocks. Follow the company's performance, the price of gold, and any industry news that could affect your investments. Be prepared to adjust your portfolio as needed. Step 7. Know when to sell. Have a strategy for when to sell your shares. This could be based on a target price, a certain rate of return, changes in the company's fundamentals, or shifts in your investment goals. The flip side. Diversification caution. Financial gurus often advise against putting too many of your investment eggs in one or just a few baskets. When you pick individual stocks, you're missing out on the broader diversification that gold ETFs or mutual funds offer. Company-specific risks. Even when gold prices are shining bright, if the company you've invested in hits a rough patch financially or operationally, your investment might lose its luster. Gold jewelry. Investing in gold jewelry can be a fascinating and rewarding venture, blending the allure of precious metals with the world of fashion and artistry. For beginners interested in navigating this shimmering market, focusing on buying, selling, and understanding the types of gold jewelry is essential. Buying gold jewelry. 1. Understand the purity. Gold jewelry's value is largely determined by its purity, which is measured in carats. K. Pure gold is 24K, but it's often too soft for jewelry, so it's mixed with other metals for durability. Common purities include 18K, 75% gold, 14K, 58.3% gold, and 10K, 41.7% gold. Higher carat gold is more valuable but also softer and more prone to wear. 2. Research the market. Before making a purchase, familiarize yourself with current gold prices and trends. Remember, the price of gold jewelry will not only reflect the market value of the gold itself, but also craftsmanship, design, and brand prestige. 3. Choose reputable sellers. Buy from reputable jewelers who provide detailed product information and clear return policies. Look for sellers who can provide a certificate of authenticity for the gold purity and any gemstones. 4. Consider craftsmanship and design. The value of gold jewelry isn't just in the metal. Craftsmanship, designer name, and historical significance can all add value. Unique or handcrafted pieces may cost more but can also be more desirable as investments. Selling gold jewelry. 1. Know your jewelry's worth. Before selling, have your jewelry appraised by a professional to understand its market value. This appraisal should consider the gold's purity, weight, and the piece's overall desirability, including any gemstones. 2. Choose the right venue. You can sell gold jewelry through various channels, including jewelry stores, pawn shops, online marketplaces, or specialized gold buyers. Each has its pros and cons, so research and compare offers to get the best deal. 3. Prepare for negotiation. Be ready to negotiate and have a clear idea of your jewelry's worth. Don't be pressured into accepting the first offer, especially if it feels too low. Types of gold jewelry. 1. Solid gold jewelry. This is the most valuable type, made almost entirely of gold or a high-carat alloy. It's durable, long-lasting, and retains value well. 2. Gold-filled jewelry. These pieces have a thick layer of gold bonded to a base metal. They're more affordable than solid gold but still offer quality and durability for the price. 3. Gold-plated jewelry. Gold-plated pieces have a thin layer of gold over base metal. While affordable, the gold surface can wear off over time, making them less ideal as an investment. 4. Gold vermeil. A type of gold-plated jewelry, but with a thicker gold layer and a sterling silver base. It's a middle ground between solid gold and gold-plated options in terms of price and durability. Minimum amount for investment. You don't need a treasure chest to get started. Gold bullion can be purchased in tiny amounts, even as small as a single gram. For those who like a bit more heft, a troy ounce, tipping the scales at about 31.1 grams, is a popular choice. When it comes to mutual funds, some might ask you to start with a certain amount, but ETFs are usually more flexible. Nowadays, with the magic of fractional shares, you can invest in stocks and certain mutual funds with as little as $1 through many brokerage accounts. Now, let's talk balance. Financial advisors often suggest that precious metals like gold and silver should make up just a slice of your investment pie. Think 5% to 10% of your total portfolio. This slice includes all that glitters, from physical metals to ETFs and other shiny instruments. A word to the wise: watch out for metal dealers who push too hard for you to buy gold or use fear tactics about the safety of your money. It's smart to seek guidance from someone who isn't in the business of selling gold. Consider chatting with a fee-only retirement advisor or a certified financial planner, CFP. Bonus points if they're a fiduciary, as they're legally bound to give you advice that's in your best financial interest, not theirs. So, whether you're starting small or going for a bigger investment, make sure it's part of a well-thought-out strategy that fits your overall financial goals. Happy investing, and may your portfolio gleam with potential.